G'day folks, we're diving down into the June updates on everything you need to know about the Canadian real estate bubble, the interest raising environment, guaranteed investments that you can now take advantage of as interest is going up, and so much more in between. If you're a Canadian, you appreciate the content, hit that like button. It helps the channel out obviously here, folks. So first and foremost, let's talk about the interest rate and what this is generally going to mean for you, your bank, and everything else in between. So the Bank of Canada, guys, they raised the interest rate now to 1.5%. They just did another 0.5% interest hike in June here. Now, CPI inflation of 6.8% is at the highest 31-year high here, folks, which is insane. At the last rate announcement in April of 2022, the Bank of Canada expected CPI inflation to average around 6% in the first half of 2022. Canada's housing market has cooled over the past few months as interest rates rise. As we mentioned, for every 1% interest goes up, historically, real estate corrects by about 10%, and this is the first time materially in a decade we're going to see substantial interest rate hikes. Quantitative tightening, or QT, began in April 25th, 2022. This will gradually reduce the Bank of Canada's balance sheet and put upward pressure on bond yields, driving up fixed mortgage rates. So let's dive a little bit deeper down into this. First and foremost, guys, I've been really fixated on this because I always look at the guaranteed investment returns, whether we're talking GICs or high interest savings accounts. I mean, you go back a year and my bank, Scotiabank, would only give me a 0.5% on a high interest savings account. Now a 360-day savings account can offer 1.55%, and damn, a 90-day savings account is going to yield about 1.4%. Again, that would be an annualized over a year, but you'd be paid out the 1.44%. GICs, if you've never heard of these before, these are guaranteed investment certificates, usually loans from banks, and these are locked up because the savings accounts you can withdraw from at any time, whereas GICs are typically locked up for a year to up to 5 years, but the annual rates of return can go anywhere from 2.8% to 4%, and this is a conversation we've broadly had many times because when people look to get returns from the stock market that historically usually pays 8 to 10%, the S&P over the last decade has annualized, I believe with that dividend at the peak, was around 16%, but as we get higher and higher guaranteed no risk return, it really starts flooding more investors to this approach in these volatile markets, giving less liquidity in the stock market and the real estate market, right? So let's talk about the real estate market from a broad view perspective, because this is what realtors always do to kind of coddle you in to doing a sale, right? So on a year-to-date basis, home sales totaled 76,000 units over the first 4 months of the year. This was down sharply by 22.9% from the same period in 2021. Nationally, home sales activity posted a substantial decline of 25.7% from a year ago levels of April of 2022. Yet the average price in a resale residential home sold across the province in April of 2022 was $985,000, an increase of 13.3% from April of 2021. The most comprehensive year-to-date average price was about $1,034,000, a sizable gain of 19.7% from the first 4 months of 2021. So this is kind of like the realtor spiel that, you know, real estate's still up. Everything's just dandy here. We're just seeing a slowdown in sales as, you know, buyers are sitting on their hands, you know, just kind of it's seeing what these overnight interest rate hikes are going to do to the market, right? But we're starting to see articles like this. GTA home prices drop 121,000 from the February peak as the rising rates just gut sales. I mean, right now people are being able to negotiate, and it is the surrounding Toronto area that is just getting impacted by far the most. And trust me, I'm seeing this on a personal level in my own area where real estate in Durham region has corrected upwards of 30%. And reading into this, GTA home sales, again, for GTA, when you take the broad perspective like realtors like to do, it doesn't look that bad. But when you zoom into these different municipalities surrounding Toronto, it starts to get a little bit more bleak, right? Because the sales in May were down 39% from last year. Prices up almost 10%, Toronto board, right? So buyers had more negotiating power last month as market started to balance out and the board finds. So first and foremost here, guys, I'm going to tell you why the real estate market is about to burst in a major way. But finally here, guys, this week's top stories: Canadian real estate bubble to pop in 2022, and Bank of Canada warns debt is a problem. Like, our own banks are advising us of problems currently currently within the market. So why is the real estate market bubble going to burst? Two reasons. First of all, realtors, buyers, fix and flippers, commercial developers are about to get royally screwed. And it's all based off the speculative market, right? The stock market looks, again, like the broader real estate market, not really that bad from like a broad view perspective, because obviously there's a lot of facets that are still holding up the broader view perspective. But when we're talking about commercial real estate developers that just saw a massive inflation increase on cost, lumber, building, employees, that they had to actually raise the prices on buyers that were locked in for maybe a 3 to 5 year build date, right? So they had to sit on their hands. But now what's going to happen is those interest rates go up and we're starting to see housing cool down. These developers that have these contracts could start seeing those buyers just purely walk away, leaving the commercial developers with these high inflated costs to build these homes and now not getting the prices that they thought they were going to get on these sales, right? So when I'm looking at the market, people that started to get over leveraged got used to these wicked gains. Again, I mean, the real estate market's over doubled since 2020 here in Ontario, which is just unimaginable. And now that these interest rates are going up, the volume of buyers are drying up. Imagine fix and flippers right now. Their guts are absolutely sinking as they highly rely on a liquid market to not only fix these properties again at an inflated rate of cost, but to be able to get rid of them and offload them while they still have the opportunity, because every month those properties sit on the market is another month that's eating into their margins. So the speculative aspect of real estate and people that were over leveraged and got used to the high liquidity are about to get absolutely slaughtered. And what that's going to do is it's going to send a ripple effect through the rest of the market, right? A lot of people are like, oh, well, Toronto's not hit that bad. Oh, the supply and demand, there's still not nearly as much supply on the market as there's going to be demand at some point. And though that is true, you still need the demand, the buyers, no matter how many there are, even if there's more buyers than supply, if they are not buying and they are bidding and lowballing and not in a rush in this market, it is inevitably going to drive those prices down. And if you're in the market for buying real estate right now, I always recommend that, owning real estate is great if you can afford it. Bubble or not, getting into a long-term stable investment that doesn't make up more than a quarter of your take-home pay, that over time inevitably you're going to be lowering the cost rather than owning a rental place where the rent's going to go up, is always the best case scenario. But honestly, do not listen to realtors here. This is a period in the market where you want to be patient. If you have a deposit, maybe sit for a month and just see how the market starts to unfold. There's no rush here. I don't think a month or two is going to make a substantial difference in the real estate market to the upside. So maybe just be patient, feel the market out and then start looking for those deals where they become most opportune, because there's going to be a lot of people getting greedy here that may have over leveraged themselves and are going to be rushing that real estate onto the market. And when it doesn't sell, they're going to be willing to take lower prices, right? And same if you're trying to buy a house, right? You might be worried that the interest rates are going up. It's going to be harder to get a loan, but that won't matter because you're going to be getting a better deal on that property. It's just the way it works, guys. And I want to pass the question off to you. And I'd love to know what you think about all of this in that comment section below. But in light of this, stay cool, stay awesome. And as always, I look forward to catching you in the next one.